myself on record and we're going to get started. So, turn off my heater. If you have any questions as we're going through, I'm just going to keep the slides going. And today we're going to finish talking about the little part of cash that I want to go through. Then we're going to go into talking about discounts again a little bit. These are trade and cash discounts, and make sure you understand the difference between the two. We're going to talk about, it's bizarre, but sales discounts, because we'll be talking about discounts, and sales returns, which I know this isn't the inventory chapter, but this is where your author likes to talk about it. And then we're going to get into accounts receivables and probably do all of accounts receivables today. Today we'll finish up talking about chapter 7, and then we'll be going over the homework, and we'll be ready for our next test on chapters 5 and 7. That's kind of the direction we're going here. So getting back to restricted cash. So cash, we said cash and cash equivalents, we defined all of that. Sometimes a company could restrict cash. So it's usually done by the company. So it could be what we say informal. And that is where the company says, hey, we don't want to use this part of our cash. We're restricting it because we want to build a new plant. So we let people know that on the balance sheet. Now, if we are setting it aside for long-term purposes, we usually classify that cash as an investment. Okay. Sometimes though, it could be a contractual imposition or restriction, meaning our bank says, hey, you need to set aside so much money. You can't use that part of your checking account because that's what's in our loan agreement. Okay. So if the debt that is contractually putting the restriction is a non-current debt, then the restriction is a non-current asset. So that part of the cash is listed as an investment, a long-term investment. If the debt is a current debt, then it would stay as restricted cash as a current asset. Okay, so one could be the company, or another could be a contract requires them to restrict cash. Also, a part of cash is called a compensating balance. Now, this is a little different than a restriction. This is an amount that actually compensates the bank for granting a loan or extending a line of credit. So what this means is the borrower has to maintain a certain balance in their checking account. Okay, in a low interest or non-interest bearing account at the bank. So the bank could use that money. So they're being compensated for giving you a loan. Hey, we'll give you $100,000 loan, but you have to keep at least $1,000 in your checking account at all times. So that means the bank could use that money. So it required some balance equals some percentage of the loan probably, and the borrower pays effective interest rate higher than the stated rate on the debt. So we'll talk about that for a few seconds. I'm not going to go into craziness here. The major part of this is that a compensating balance is when the bank maintains or requires the company maintain a balance in their checking account or a low interest account because the bank loaned them money. Now, a company borrows $10 million from a bank at an interest rate of 12%. That's the stated rate of interest. That means the company needs to pay 12% interest on $10 million. The bank requires a compensating balance of $2 million to be held in a non-interest bearing checking account. So what it's saying is, we'll give you 10 million, but you've got to keep 2 million of it in a checking account at our bank. So are they really using all $10 million? No. They're only allowed to use 8 million, but they're going to be paying interest on 10 million because that's what they borrowed. So we can calculate what we call the effective interest rate, which is the actual interest rate they are paying. If you're going, well, no, that's 12%. Not necessarily. They are paying 12% interest on $10 million. That's 1.2 million. But they're not using all $10 million. They're only using 8 million of it. So it's like they borrowed $8 million. So they're paying on $10 million borrowing, but since they only get to use 8, it's like they only borrowed 8. So what's the real rate of interest they're paying on this money? 15%. So the bank, that 12%, 15%, that difference, that's what the bank is making on the company, because the company is required to keep that $2 million in the checking account. So we just want to bring that to your attention. You got to be careful of that kind of stuff. Any questions? Okay. I'm just going to go through. I'm not going to spend a huge amount of time on that. I'm not worried about IFRS. Okay. Here's where I wanted to get to. So we're done with cash. That's about it, except for the appendix. We'll be looking at bank reconciliation. We're going to look now at accounts receivable, which is really, 2/3 of our chapter. We talk cash, accounts receivable, big portion of it, and then notes receivable. We are very familiar with accounts receivables. Remember, they're created when the seller recognizes revenue with a credit sale. So basically, the company performs a service or provides a product, and revenue is recognized, and accounts receivable is recorded for that, excuse me one second, for that sale. Okay, so it's created. Most businesses provide credit to their customers, so that's why it's really important we talk about them. These are informal credit arrangements. The proof of it is an invoice usually, or a bill that's due no longer than 30 to 60 days from the sale. Very, very short term. So short term, it's not worth charging interest on. So we don't. Usually it's classified as a current asset because the money's collected so quickly. And we know that already. Remember how we account for revenue, right? So a seller has to recognize revenue equal to the amount they are entitled to receive. Sellers allocate the transaction price. Okay, we're not worried about this too much. Know this. When does a company recognize revenue in the ensuing accounts receivable? They recognize it when either the service is performed or the product is provided. That's basically what these 2 bullet points boil down to. Now, they do talk about time value of money. We don't really need to worry about it with accounts receivable because the time period is so short between when the transaction occurs and is recorded and the cash is collected. It's not worth calculating any kind of interest related to it. So it's about the same, the time value of money, present value and future value. It's so close in time, you don't have to worry about that calculation. Don't worry about variable consideration. We'll talk about that in Accounting 212. Just so we understand, accounts receivables are created when we sell or provide a product. Now, and we didn't get the cash yet, right? We want to make sure we understand the difference between 2 major types of discounts. Usually these are introduced in an inventory catalog, I don't know where the word catalog came from. Chapter, an inventory chapter. I'm thinking about list price in a category, in a catalog. So that's why I said catalog. But usually we talk about these when we are in our inventory chapter, but because they do affect accounts receivable, we are introducing them now. First of all, these are our two major discounts. A trade discount is never recorded in our accounting records. Now, what is a trade discount? Usually, and this is where catalogs come in, maybe a company puts out a catalog and it says, here's the list price for this computer. Okay, so if you're the average Joe walking or looking through our catalog, you're going to pay $3,000 for this computer. But because one, you order a huge amount from us, okay, or maybe you're a repeat customer who always buys from us, we're going to reduce that list price. So they give you a trade discount. So the list price is $3,000, but company A, you could take a 10% trade discount. So they're going to take 10% off of the $3,000. So they're actually purchasing it. And if we were the company selling it for $2,700. Okay. And that's how we would record the sales revenue. There's no special account and we don't keep track of trade discounts. Sales discounts are different. Sales discounts occur after the sale. And they occur because a customer pays their bill early. So this is a reduction in the amount to be paid by a credit customer if paid in a specific period of time. So if you remember from your Accounting 111 experience, we have credit terms. It's usually 2/10, comma, n/30. So that's not supposed to be a fraction. The 2 means 2% discount. So that's always your percent discount. The second number is the number of days of the discount from the date of sale. So if the customer pays it in the first 10 days from the sale, they could take a 2% discount. If they don't pay it in the first 10 days, they owe the full amount. Sometimes people say no discount or net meaning full amount by this day from the sale, the 30. So pay it in the first 10 days, take a 2% discount. Don't pay it in the first 10 days, pay it by the 30th day, the full amount. So let's see this in action. Now we're going to look at two different ways companies have to choose from to record sales where there's a discount, a sales discount. One is the gross method and one is the net method. They're both acceptable. It's a company's choice. Hawthorne Manufacturing Company offers credit customers a 2% sales discount if the price is paid within 10 days. Any amounts not paid within 10 days are due in 30 days. So 210 and 30. These repayment terms, there you go. On October 5th, 2021, Hawthorne sold merchandise at a price of $20,000. The gross method, we record that sale at its gross amount. Debit accounts receivable, credit sales revenue. Now we'll come back and look at the net method in a second. So we record assuming the customer will not take advantage of the discount under the gross method. That's basically how you can look at that. Now it says on October 14th, they received $14,000 of that bill. Since it was paid in the discount period, the customer will take a 2% sales discount on that $14,000. So they'll only owe $280 or I'm sorry, 13,720. That's what they'll be paying. Take a look. Under the gross method, we credit accounts receivable for the portion they're paying off, the $14,000. Debit cash for the actual cash they'll be paying, and then we debit a contra sales revenue account. Remember, contra sales revenue account, sales discount. So that account actually decreases the sales or sales revenue account. The remaining 6,000 balance is paid outside of the discount period. I'm going to go to the next slide, and then we'll come back and look at the net method. So when the remaining money is received under the gross method, debit cash and credit accounts receivable for the full amount. So we recorded the accounts receivable as if the customer would not take the discount, the gross method. Then when they do take either the whole or part of the bill as a discount, the discount is debited to sales discount. Net method's a little different. Net method, we record the sale assuming the customer will take the sales discount. So we find out, what will the customer pay if they pay in the discount period? Well, we take 20,000 times 2%. That'll be $400 discount. And then subtract it from the 20,000. Now, the shortcut here is we could say, well, if 20,000 is 100%, and they're going to pay us 2% less, then we could expect 98% of the 20,000 if they pay in the discount terms. So we debit accounts receivable for the net. That's why we call it the net method. Accounts receivable, 19,600. Credit sales revenue, 19,600. Then, when the customer does pay in the discount time, debit cash for how much they're paying, 13,720, and only credit accounts receivable for 13,720, because that's how you originally recorded it, as if they would pay the discount. No sales discount in this method. Now, what about that $6,000 the customer pays outside of the discount? Oh, here's how we record that. They're going to pay that full $6,000, debit cash. We only credit accounts receivable for $5,880. Why? Well, we recorded it, that $6,000, as if they were going to take the discount. So only 98% of the $6,000 is still sitting in our accounts receivable account on the debit side. So we can only credit accounts receivable for $5,880. The difference is credited to what's called a sales discount forfeited. That's a revenue account, and it's put in other revenues and expenses on our income statement. So it's like one of the last items in our operating area. Okay, so the method you pick is up to you, but you have gross method, you assume the customer won't take the discount, and if they do, you put the discount they take in sales discount. Net method, assume they will take the discount, and for any part they don't, put it in a sales discount forfeited account as credit. Questions? Okie dokie. Now let's go to, so they're just showing you overall how much net sales revenue gets recorded under either method. Well, when a customer takes a discount under those same terms, whether they're paying the bill or we recorded it as gross method, the total overall revenue will be the gross amount of the sale minus the discount they actually take. If we do the net method, it'll be the net amount of the sale because we assumed people would take the discount, but the part they don't take will be added into income. So it's not like you're increasing income using one way over another. It's just a preference. I usually see gross method. And I think they might, I don't have my book at home because I kind of did this on the fly. I'm actually in a tax seminar right now, but they might give you the percentage of companies that actually use this method versus the gross. Okay. Little questions there. You guys can take a, which one is correct? Sales revenue and corresponding should be stated at the amount of consideration the seller expects to be entitled. The net method typically better reflects that amount because the discount is a savings that prudent customers are unwilling to forego. Oh, this is getting too crazy here. Don't worry about that. Sometimes they go a little bit too far with stuff. So we just want you to get the basic idea of gross and net and the journal entries related to it. Now sales returns. And you're like, sales returns, what does that have to do with accounts receivables? Not a lot, okay? It's just that your author talks about them, so what the heck, we'll get them done and over with. So remember, sales returns is when a customer brings back merchandise and we give them a refund. We may give them cash refund, or we may reduce their accounts receivables, so that's a credit. We can also offer a customer an allowance. And what this is saying to the customer who says, hey, there's something wrong with this merchandise I bought. And we say, well, do you want to return it? And they go, well, no, but I don't want to pay full price. Could you reduce the selling price? Can you give me an allowance? Absolutely. So an allowance is when us, the company, allow our customers to pay us less than they originally bought the item for. So we'll reduce the amount they pay or they owe us. Now, we got something funky going on now, which started about 4 or 5 years ago when they rewrote our revenue principle, which is all of chapter 5 or 6, chapter 6. That's why we skip it. We do it next semester. But they introduced us to a part of it that you didn't learn back in Accounting 111 because it was just too crazy. But now you're going to learn it. Here's what happens. And for many years, when we had a customer bring back merchandise, that's when we debited sales returns and allowances. Remember, sales returns and allowances is a contra revenue account. So back in Accounting 111, when you learned sales returns, you said, oh, a customer brought back, water bottle. Okay, how much do we owe them because they're returning that? Oh, $20. Okay, debit sales returns and allowances, a contra revenue account, credit cash because we gave them a cash refund. Okay. So that's how we did it for the longest time. But of course, the FASB decided to change it a little bit. So this is about maybe even 3 years ago. Sometimes what the FASB looked at and said, wait, sometimes you may sell this water bottle in one accounting year, but not get it back or returned to you until the next accounting year. So you are actually overstating your sales for this year and understating them for next year because you're recording the return when it actually happens next year. Now, that's not good. No. In accounting, we're trying to show exactly what happened this year. So what we're going to start doing is at the end of this year, we're going to try to estimate how much of this year's sales are actually going to be returned in the future and record them now, even though they didn't happen yet. And that's what this bullet is talking about. So here's what I was just saying. You sold merchandise in 2021 that cost $6,000. You recorded revenue of 10 and cost of goods sold and expense of 6,000. So this $4,000 went on your income statement as gross profit. But then next year, that merchandise came back, it was returned. What does that mean? Well, next year when you return that, you're going to decrease revenue by 10,000 and increase expense by 6. Okay? So now you're understating this year's revenue. Why? Because that item was from last year, not this year. So ultimately, you're overstating revenue in 2021 or overstating net income and understating it in 2022, just because of the way it turned. FASB says, we got to do better than that. So here's what they say to do. Let's look at it as an example. During 2021, its first year of operations, Hawthorne sold merchandise for $2 million cash. The merchandise cost Hawthorne $1.2 million. So we debit cash, credit sales revenue, debit cost of goods sold, COGS. There's our acronym, and that's how we pronounce it, COGS. Cost of goods sold for the cost of that, 1.2 million, and credit inventory. So we recorded this year's sales. Now, what the FASB says is, don't wait until next year when the stuff is actually returned to debit a sales returns and allowance account. No. Industry experience indicates 10% of all sales will be returned. Okay, and if we don't want to use the industry, well, this is the first year of this company, so they have to use the industry. But usually a company will say, well, how much of our sales are usually returned? And they'll use that percentage to estimate. Okay, usually back in the old days, when we had sales returns, we would debit sales returns and credit cash. Then we would debit inventory and credit cost of goods sold. Okay. And you could do that. Okay, but remember something back here. It says, of all these sales, 2 million, we expect a total of 200,000 to come back. So far, 130 have been returned. So it's okay to record those sales returns this year in our first year of operation, because that's when the revenue was recorded. But what about that other 70,000 we still expect? We expect a total of 200. We already had 130 come in. Record them this year. This is an adjusting journal entry. And yes, it's an estimate, but that's okay. At the end of 2021, we're going to debit sales returns for an additional 70,000, even though they weren't returned yet. We credit, since we're not refunding the money actually right now, or giving the refund to a specific customer, a liability account called refund liability. That's where we store that estimate. So now we're going to properly decrease the sales for this year, 2021, by the amount we expect to be returned from this year's sales, all in the same year. Now, normally, when we're recording a return, we debit inventory and credit cost of goods sold. Well, we will credit cost of goods sold for the cost of that expected inventory. So you've got to decrease that account as well for this estimate. In the problem, a slide or two ago, it says cost is 60% of sales revenue. So 60% of 70,000, we still have inventory we're expecting to come back to us that cost $42,000. So that's our original amount we paid for it. We need to credit cost of goods sold this year. If we left that amount in cost of goods sold, it would look like it's sold and never coming back. We expect some of that to come back. So credit cost of goods sold this year. Since it isn't back yet, we can't debit the inventory account. We debit a separate inventory account called, and it's an asset, inventory estimated returns. So this is an adjusting journal entry made at the end of the year to make sure that we properly estimate for returns from this year's sales, and anything that hasn't been returned from this year's sales, we properly make a journal entry for. I know that's kind of crazy. Any questions on that? So what happens? Next year, when the sales returns actually happen during 2022, and the assumption is here that 70,000 was returned from customers. We don't debit sales returns. We already did. We estimated for that. We debit that liability account, refund liability. We're refunding the money now. Reduce that liability, credit the cash account. Now the inventory is back. We actually own it again. Debit the actual inventory account for 42,000 and credit that asset inventory estimated returns for 42,000. Okay, so this is a exercise that is brand new, really, only, like I said, 2 or 3, maybe 4 years now. I don't know, the years keep going away. At least the minimum is, maximum, is 5 years that they changed this requirement. So we have to start estimating now and getting recorded in the year of sale any return we expect that has not been done yet, that we expect in the future, get it recorded this year. Then when it actually is returned, this is our journal entry to record it. Let's take a look at another. Accounting for sales returns, correcting estimates. If the estimate of future sale returns turns out to be wrong, the new estimate is incorporated into accounting determinations in the next period. Take a look. Suppose in 2022, the actual returns from the 2021 sales are 60 instead of 70. Well, we would debit refund liability for 60 and credit cash for 60, right? That's not the journal entry there. But we would still have $10,000 left in our refund liability account. Well, we wipe it out. We debit the refund liability for any excess estimate or, either way. So if we estimate too much or not enough, we make sure our refund liability account is zero at the end of the year from what its balance is. So we have to debit it in this case. And then credit the sales returns. We do the same thing for the balance of that estimated inventory. So that's your focus here. Get that account to zero before you do any estimating for the current year, and debit cost of goods sold for the difference. So you debit cost of goods sold for 6,000, credit the inventory estimated returns. So your focus is, do I have a balance in my refund liability at the end of the year? Get that to zero and do the opposite to sales returns. Do I have a balance in my inventory estimated returns? Yes, $6,000. I need to get that to a zero balance, so I'll credit that for 6,000, debit cost of goods sold. Are there any questions? So you do correct that one. We're not used to correcting our estimates like this. We're used to just adjusting for future estimates, but we actually could go in and get those accounts to zero before we estimate going into the next year. Let's take a look at another example. $5 store sells merchandise for cash. It began 2021 with a refund liability of zero. So draw a little T account right in front of you. So we have a liability account, refund liability, and it currently has a zero balance. Good. They made sales of $1 million during 2021, and the costs of those sales, so the cost of the items they sell, are $600,000, or 60% of sales is the cost. They estimate 1% of all sales will be returned. So take 100,000 or 1 million times 1%, that's $10,000. So of the 1 million, they expect to receive back $10,000. During the 2021 year, they actually did receive 8,000. So when they're doing their estimate in their adjusting journal entry, how much will they debit sales returns and credit the refund liability? $2,000. Okay, so they didn't need to worry about clearing out any balance in their refund liability account. It already had a zero balance. If there was a balance in there, they would have first made sure that was at zero, then did this estimate. Questions? All right, let's keep going. They sell merchandise for cash, but get same scenario. When it's accruing its estimate of remaining returns at the end of 2021, what amount will they debit inventory for and credit estimated returns? I'm sorry, debit inventory estimated returns and credit cost of goods sold, because on this slide, we only did how much do we debit sales returns and credit the refund liability, but these items have a cost. So we have to credit cost of goods sold for their cost and debit that inventory estimated returns asset. Remember, the items cost 60% of revenue, so 1,200 is our magic number. So our total entry would be sales returns, debit for $2,000, credit the refund liability, $2,000. Debit the inventory estimated returns for 1,200, credit, cost of goods sold, 1,200. So that's our estimate. I know this is brand new, so are there any questions on that? already. Let's keep going. Okay. All right. So we saw trade discounts we ignore, but sales discounts are when there's discounts because the customer's paying their bill early. We saw the gross method, the net method, and now we saw these sales returns in this estimating process. Now we're going to fly into accounts receivables. Okay, so remember, accounts receivables, you are entitled to receive payment. But just because you're entitled, you're legally entitled to this, doesn't mean you're going to receive it. And when I talk about this, I say, you know, because I know in my mind learning this, I'll be like, well, why'd you even sell to that person if they're not paying you? That's so stupid, you know? But we don't sell to people we don't think are going to pay us. I mean, you're not going to give somebody money if you don't think they're going to pay you back. Well, companies don't do that either because the sale isn't final. It isn't good until you actually have the cash in your hand. So we try to only sell to customers on credit that will actually pay us. But the real world is not our theory world. You know, in theory, everybody pays their bills because everybody's cheery and happy and makes money and their life's wonderful. But the reality of it is that, you know, bad things happen to good people and bad things happen to bad people. So, and companies, something could happen to a company that may owe you money. Their owner may die and the business just stops operating. Okay, and it's going to take them a little while to get back in gear. They may not be able to pay you. I've seen companies just disappear. You know, I've had that happen. I went looking for somebody who owed a company I worked at money, and it was just an office with a desk, and they were gone. There was no way to track them down. You know, so people could file bankruptcy. You know, you could have a customer that owes you maybe $5,000 and their customers file bankruptcy or stop paying them. Then they don't have money to pay you. So there's many different things that could happen even to our good customers. So we always have to keep in mind, we always will have a component of our accounts receivables probably won't collect. Those are called bad debts. And they're just a cost of allowing people to pay you on credit. Now, how we account for bad debts is different. Whether you're doing a tax return, which poor Penelope, she was in taxes this morning and I was talking about this, and Frank, you'll be watching it too, and Alyssa, and everybody else who's listening to this, except for you, Kels. But, you know, we have one method of accounting for bad debts on our tax return and a totally different method. And yes, there's two different ways and they're both, that's legal, for doing our financial statements. So I want to talk about the direct write-off method, but you can see it says bright and bold letters, not GAAP, because it violates a major principle in our rules to create financial statements. But for taxes, you use the direct write-off method and not the allowance method. Crazy. So let's take a look if I can get this to advance. Come on. All right. So the direct write-off method. What we do here is we wait until an account becomes uncollectible. So an actual bad account. And that's when we record any bad debt expense related to that account. Now, generally, you can't use this for GAAP. But there'll be that one little sentence in your book that says, well, unless it's an immaterial amount and it's about the same it would have been under the allowance method. Your bad debt expense would have been about the same. But generally, we don't use this method. Okay. And there it is. So let's say we have a company who owes us $15,000. When we get notification or feel we will not collect this money, that's the day we debit bad debt expense and we credit accounts receivable, no matter when the sale was made. Under the direct write-off method, they go, we don't care when the sale was made. It could have been made 2 years ago. Today we feel we're not going to get that money. Today's the day we call this bad debt expense. Well, we don't use that method. So I'm just going, I want to show you the why. I just don't value. Yeah. Okay, let's see. Let me get my Word doc. Share that so you can see what we're talking about. Oh, come on. There we go. Okay. So let's say we'll go kind of with what that journal entry we just did. Let's set up a scenario. Let's say it is 2020. And here's the only transactions this company has during 2020. Company A sells $500,000 of product on account. I'm not worried about debiting cost of goods sold and crediting inventory. We're not talking about that here. We're talking about accounts receivables. So that's all I'm going to focus on. Well, during 2020, Company A would have debited accounts receivable, $500,000, and credited sales revenue, right, for $500,000 to record that those sales on account. Here's your other transaction during 2020. Company A collects $80,000 on account. So of that $500,000, they received $80,000 of it by the end of the year. So they debit cash and credit accounts receivable. That's it. Those are the only two transactions. When they do their income statement for the year 2020, the company's going to have sales, 500,000. There's only 4 accounts there. Actually, there's 3, right? The only one that affects the income statement is sales revenue. So their expenses will be 0. So they have net income of 500,000, according to what we're doing so far. And this is the direct method. Remember, the direct method says, oh, don't do anything with bad debts until something actually becomes uncollectible. Well, now it's February of 2021. Let's call him customer B. Customer B, who owes Company A $3,000, files bankruptcy. Okay, Company B, who owes Company A $3,000. So of that $420,000 still owed to Company A, $3,000 of it doesn't look like we're going to get. Now, when a company files bankruptcy, if you've taken business law, you might have talked about bankruptcy rules. And, when a company files bankruptcy, the company doesn't say, oh, we're bankrupt. Oh, okay, Company A, we really like you, so we're going to pay your bill. We're not going to pay that other company. No, all the assets of customer B go into bankruptcy court, except for like certain amounts they'd let you keep. But it goes in a big pot, essentially, that's how you can look at it. And then there's laws related to bankruptcy that say, okay, first, if they owe any taxes, taxes get paid. Oh, make sure you pay their accountant and their lawyers. I'm not sure if they're first or second anymore, but I knew they were high on the list. Taxes are high on the list. Okay, now you're going to pay any secured creditor, meaning if there is a customer A, B has a loan that they have collateral, like they use their house or their car or something. Well, that loan gets paid next. And then it keeps going down. Guess where our accounts receivable is? Almost last, if not last. So usually when a customer on an accounts receivable goes bankrupt, we're not getting our money. So in February 2021, under the direct method, debit bad debt expense, $3,000, credit accounts receivable. So increase the expense account now and actually call this an expense. Wait till it becomes bad, debit bad debt expense. And reduce your accounts receivable. And you might be sitting there going, well, that makes sense. But let's pretend that's all that happened. That's the only thing that happened all year at Company A. Let's do their income statement for the year 2021. Their revenue, I'll bring this up a little bit, will be 0. Their expenses, 3,000. So under the direct method, they would be recording, let me get rid of that underline, a net loss of $3,000. You might be saying, well, what's the big deal there? They just violated a major rule in accounting, which we learned back in chapter 1. This violates the expense, or what we call the matching recognition principle. And I wish I had my book in front of me, but if you go back to chapter 1 and read that, they tell you when to recognize an expense. And one of them says, recognize an expense caused by a revenue in the same accounting year. That's why we call it the matching principle. Match expenses with the revenues that caused them. So if you have an expense that is it's caused by a revenue, you should report them in the same accounting year. Here's the question. If you sold these items for cash, would you have bad debt expense? No. The only reason you have bad debt expense is because you sold these up here on account. So this expense is caused by this revenue. They should be reported in the same accounting year, not different accounting years. So that's why we don't use the direct method, although it's really easy, right? You don't have to think about it a real lot. Okay, so you keep that for your tax return. So you're allowed to do that on your tax return, but not in this class. Questions? So let's talk about what we do, the allowance method. And you may remember this from our, whoops, share my other screen. From our Accounting 111. There we go. There we go. So we use what's called the allowance method. So there it is. GAAP requires it. So generally accepted accounting principle says you have to use this method if your bad debts are material. They're significant. Now we're going to bring you back to, we use a special contra account during this method. Back in Accounting 111, we might have called it the allowance for doubtful accounts. Your author likes to call it the allowance for uncollectible accounts. It means the same thing. Its purpose is to store estimate of future bad debts from this year's transactions. And it will actually reduce our balance on accounts receivables on our balance sheet. So there is an example of it. I don't know what company this is, but it says accounts receivable less allowance for, and there's the word doubtful, there your author uses uncollectible, but either is appropriate, accounts of 291. So what this is saying is, if you take the 13,490, and I know it's in millions, but I'm going to say 13,490, add the 291, the total amount of accounts receivables that is owed to this company is $13,781. But they've subtracted out the amount they don't expect to collect. That's the estimate in the allowance for doubtful accounts. And the difference is what they expect to collect. Jot this down. We also call that difference net realizable value. It's the amount we expect to get. That's what net realizable value is. And back in chapter 1, when we were talking about the different amounts, we said you should record stuff at cost, or we talked about present value back then. You don't probably remember, but we also said net realizable value. And this is where we would record this asset and what we expect to receive from it. What's owed to us minus what we don't expect to collect gives us that number. Now, bad debt expense is not recognized. So you do not debit it when you write off a specific account, like customer B. It's recognized earlier. The only time you will use your bad debt expense account is when you're estimating. That's it. Then, when an account is written off and it's actually uncollectible, you will debit the allowance for uncollectible accounts and credit accounts receivables. So we're just walking you through it. We're going to go through examples. So let's take a look. Hawthorne Manufacturing Company started operations in 2021. Okay, so it's its first year. It had sales of 1.2 million on account. So there is the accounts receivable debit, 1.2 million, and it collected 895,000 of it during the year. So the balance at the end of the year in their accounts receivables, 305,000. Now, this company knows, even though it's its first year of operations, they probably won't collect all of that money. They don't know who's not going to pay them, but they're probably not going to collect it. What the company does is says, well, we've done some analysis, and before we used to just look at stuff very globally and not pick our accounts apart. Now we actually have to start picking our accounts apart. And it's a new way of determining the amount that won't be collected. So what Hawthorne does is approaches it and says, you know what? We expect to only collect 280,000 of that 305 that is owed to us. So they're using accounts receivables, and they did some analysis of their accounts receivables to determine how much do we really expect to collect. Maybe they went and they saw one of the customers started really slowing down on their payments, or they've been in contact with them and they found out they're having some issues with cash flow. So they're not as confident about collecting that money as maybe when they sold to them. So they're really taking a good look and saying, what do we really feel like we're going to collect? So you don't have to worry about doing that. That's something you get with experience out in the field. We're just telling you how they came up with that 280,000. Well, the difference should be when you're using accounts receivables to determine what you're going to receive in the future, that needs to be the balance in the allowance for uncollectible accounts, that contra accounts receivable. So since there's no balance in it right now, and it needs to have a credit balance so that it will reduce our current balance in accounts receivables, so it'll be 280,000, we credit it. And then this is when we debit bad debt expense, even though nothing went bad yet. That's the rule. Get the expense recorded in the same year the sale occurred. So let's take a look. Green Valley Steel had sales of $1 million and collection of 760,000. That means their accounts receivables at the end of the year were 240,000. They did some analysis and they determined, we're only going to collect about 200,000 of that, we feel. That's our best feeling for that. What will it do at the end of the year? It will debit bad debt expense for the difference and credit the allowance for uncollectible accounts. Remember, one more time, that allowance account, allowance for uncollectible accounts, is a contra account to accounts receivable. It's where the credit balance is how much of accounts receivables the company does not expect to collect in the future. So, B. And there's your journal entry. So that's our estimating. And that's an adjusting journal entry done usually at the end of the year. So what does happen when an account actually does become uncollectible? So they estimated for accounts receivables not to be collected in the future. They did that back at the end of the year and they felt 20,000. They concluded they will not collect a 15,000 accounts receivable from a customer that recently has gone bankrupt. So they do not debit bad debt expense. No. Now reduce the contra account. Remember, you thought 20,000 in total would go bad. Well, as things become actual, reduce that estimate. So you want to get it to as close to zero as you can. It's not always going to be there because you're not perfect at estimating. But you increase the allowance on the credit side, and then when things actually go bad, you debit it, decrease it. And then credit accounts receivables. Now, below, they're just showing you the T accounts that no matter which method you're using, you're always crediting accounts receivable when the account actually goes bad. And this should be allowance method, specific write-off. We screwed up that slide there. So let's kick it up a notch. What happens if we did this, right? Over here, we have this customer, they file bankruptcy. When somebody files bankruptcy, you should just probably automatically write off the entire account, uncollectible. But what happens if, it's, a couple of weeks later or whatever, and you receive some of that money? So you wrote off an account, but then you received the money. For instance, assume Hawthorne learns that on May 30th, that the financial situation of its customer has improved and it's going to collect 1,200 of the receivable they thought they would never get. Two-step process. The first thing you have to do is reverse the write-off for the dollar amount you expect to collect. So we're going to reinstate 1,200 as accounts receivable and put it back into the allowance for uncollectible accounts. Why? Because that part of the allowance for uncollectibles is no longer an actual bad debt. Remember, we debited for 15,000. Whoop, put it back in. Oops. And so let me go back. When you collect that money, you'll debit cash and credit accounts receivable. They don't show you that part of it, but you just do it like a normal collection. So we've run through the in the allowance method. Let's just go back and go through those one more time. So we have Hawthorne here, sells on account and collects the money. At the end of the year, they don't expect to collect $25,000 of it. That's their estimate. So they debit bad debt expense, credit the allowance for uncollectible accounts, store the estimate in the contra accounts receivable. I know, oh, sorry. Then the next year, when an account actually does go bad, become uncollectible, we reduce the allowance for uncollectible accounts by debiting it and credit accounts receivable. If we should collect some of the money that we thought we weren't going to get, we have to reinstate that part as debit to accounts receivable and credit the allowance for uncollectible accounts. Then when we collect the cash, debit cash, credit accounts receivable. So those are the major journal entries. And we saw one way of estimating. The thing of it is with this method, they give us a few different ways to choose from to estimate for future uncollectible accounts. Now, what we saw was called the balance sheet approach. So the balance sheet approach, we use accounts receivables to estimate future uncollectible accounts. And that's what we did in our examples here. We said the balance in accounts receivable is 305. We think we're only going to get 280. When we use accounts receivables to estimate, we are determining what the new balance has to be in the allowance for uncollectible accounts. And then we create a journal entry to get it there. So that's your focus. Here's what I used accounts receivable. According to my accounts receivables, here's the estimate I will not collect in the future. I need that to be the balance in my allowance for uncollectible accounts. Now I'll get a good journal entry to get there. This is our current expected credit loss model. As I said, look how new this is. This method is required starting in 2020. Before, we usually base things on past experiences and just said, oh, what don't we usually collect in the past? Now we have to be much more detailed with our analysis in coming up with our estimate. We need to look at historical experience, the current economic conditions like the COVID, how's that going to impact our accounts receivables in the future, and our forecast. So we analyze our customers' accounts. We may apply an estimate, a percentage of bad debts, to an entire outstanding receivable balance. So there's different approaches here is what we're saying. So let's take a look at these. One very, very common approach to estimating bad debt that would fall into the CECL model is what's called the accounts receiving aging schedule. Now, what we did in our example, in our first example, is we said, okay, here's all of our accounts receivables analysis. We don't expect to collect about 280,000 of them. So we looked at our accounts receivable balance as a total and estimated based on that. A more refined and detailed approach to estimating amounts when we're using our accounts receivable is to drill down into it, dig down into it. and really take a good look at it. And one great report, I love this report, that is produced by our computer systems now is called an aging of accounts receivables. So you would be given this report. Now, what's on this report? It gives us each customer, what they owe us in accounts receivables, and how old that balance is. So this would be given to us. This report is as of December 31st, 2021. These customers owe us this much. So our total accounts receivable balance is $305,000. So that will agree to our balance in accounts receivable. Now, the first column here is 0 to 60 days. What does that mean? That means this accounts receivable was created in the past 60 days before December 31st, 2021. So any amount in this column, the sale occurred between 0 and 60 days before December 31st, 2021. Any balance in the next column, the sale occurred 61 to 90 days before December 31st, 2021. So this first column could be looked at very new amounts owed to the company. Now they're getting a little older. 91 to 120 days, these amounts were from sales that happened 3 months to 4 months ago, 91 to 120 days ago. And then any amount in that final column, and it's usually that's your last column, these sales occurred over 120 days ago, so 4 months ago. These are pretty old balances. Remember what we said about accounts receivables. They're usually paid off 30 to 60 days. So what a company does is, and the collection people, oh, I love this report when I was doing collections, because you focused on these 3 columns right here and started calling these people going, where's my money, right? So as these things get older, it's going to be harder to collect them, because if people were going to pay you, they would have paid you by now. What we do when we're estimating, though, is we just focus on the total of each age group. And then we say, okay, based on our past experiences in our company, how much of this age group usually becomes a bad account? And the company came up with 5%. Then we go to the next column. How much of this age group usually goes bad? And based on their past experience, they figured about 10%. They do the same thing with the 91 to 120. Look at now, it's getting really high, 20%. And if this amounts in this over 120 days, there's a 40% chance they're not going to collect it. That's how much they expect not to collect. So don't try to, I used to do this when I was learning this method, try to add these up to 100%, no, because each group separately is considered 100%. So they expect 95% of these will be collected, and 90% of the 50,000, and 80% of the 25, and 60% of the 10,000. So we multiply each group's total by the expected amount not to be collected. So there's 11,000, 50,000 times 10% or 5,000. 25,000 is the 91 to 120 day times 20%. So 5,000 is not expected to be collected. This is our estimate. And then the over 120 days. Then add those amounts all up, and the company expects that they will not collect $25,000 of accounts receivable. They are using accounts receivables here to estimate. So what did they just determine? The allowance for uncollectible accounts, new balance at the end of the year. So now they have to go make a journal entry to get it there. Any questions on this aging schedule? I always used to use this when I was estimating accounts receivable, bad debts and accounts receivable. Okay. So let's just change this up. Let's say at the end of 2022, Hawthorne has a gross accounts receivable balance of 400,000, but believes it will only collect 360. So let's say they used this schedule and this amount came out to be 40,000. Hawthorne needs an allowance balance then of 40,000. Here's the current balance. They have a credit balance currently in the allowance for uncollectible accounts at the end of this year of 11,200. Let's make sure we understand what that is. Last year, the company did their estimating. Okay, and whatever that amount came out to be, this year, Hawthorne's been debiting the allowance for uncollectible accounts every time an account actually goes bad. Well, it looks like they overestimated and they still have 11,200 of last year's estimate still in the allowance for uncollectible accounts. Okay, well, that's okay. The FASB and GAAP doesn't say, oh, we'll zero that account out. No, they just say, okay, either you need to credit this account, the allowance for uncollectible account, to get it from a balance of 11,200 to 40,000, your new estimate. So debit bad debt expense for 28,800, credit the allowance for uncollectible accounts. So in our previous examples, there was no balance in the allowance for uncollectible accounts. But now when we have one, you see how we do that adjusting journal entry. Are there any questions on that? What if this was happening instead? Check this out. Now at the end of the year, Hawthorne, before they do their journal entry for estimating for this year, they have a debit balance of 2,000 at the end of the year. Now remember again, at the end of last year, you credited the allowance for uncollectibles, and this year you've been debiting it for actual bad accounts. You debited it so much that you have a debit balance in it. So that means at the end of last year, you didn't estimate enough. You were off estimating. So what? It happens. You're estimating. Let's correct it now. So at the end of this year, where's the journal entry? Okay, we debit bad debt expense for 42,000, credit the allowance for uncollectible accounts, 42,000. So that's how we correct a debit balance and get it to our proper credit balance. And the last scenario that could happen, what if you determine that only 5,000 should be your allowance for uncollectible accounts, and before the adjustment, there's a credit balance in it of 11,200. Well, you'll debit the allowance for uncollectible accounts, 6,200, and credit bad debt expense. So you focus on what you have to do to that allowance for uncollectible accounts, and you do the opposite to bad debt expense. Remember, what are you using to estimate for bad accounts? Accounts receivable. So that's the more difficult approach, because you always got to remember, what am I doing? Oh, I'm trying to figure out the new balance in the allowance for uncollectible accounts. Oh, okay. Now I got to make a journal entry to get there. Another approach to estimating bad accounts is the income statement approach. And here you use your credit sales or total sales to estimate. Now, when you're using the income statement approach, you're figuring out how much to debit bad debt expense for. And then you do the credit to the allowance for uncollectible accounts. So you don't worry about what the balance is in the allowance for uncollectible accounts. So here's an example. Hawthorne had sales of 1.2 million and it estimates 2% of its sales. So now it's using sales to estimate. Before they used accounts receivable. How will they record this? Well, take 2% of 1.2 million. That's how much you debit bad debt expense for, and credit the allowance for uncollectible accounts. And there you go. And then you could do stuff in a combined approach, which I'm not going to worry too much about that. Okay, I think I'm just about out of time. Oh, I got 2 or 3 minutes. Let's take a look. Berkeley uses the balance sheet approach to estimate bad debt expense. So there is balance sheet, that means accounts receivable. It started 2021 with a credit balance of 10,000. So if you make a little T account and put 10,000 on the credit side and call it the allowance for uncollectible accounts, Berkeley wrote off 200,000 of bad debts during 2021. So that means they debited bad debt expense, or I'm sorry, they debited the allowance for uncollectible accounts, 200,000, and they credited accounts receivable. So right now, there is a $190,000 debit balance in the allowance for uncollectible accounts. The company uses the aging of accounts receivable, so that report we just talked about, to estimate uncollectible accounts. And they determine $5,000. But when you use the balance sheet approach, accounts receivable, you're determining the new balance in the allowance for uncollectible accounts. So you need to create a journal entry to get it there. So the answer is A, you need to credit the allowance for uncollectible accounts for 195,000 to get it from a debit balance of 190 to a credit balance of 5. And then you debit bad debt expense. Questions? That's probably it. Okay. You could read through the current expected credit loss model for accounts receivable. I'm not going to go through everything there. So you could just take a look at that and read through it. But yeah, that's accounts receivable. So I'm just going to stop sharing that a second. I just want to call up, just give me 1 second to take a look at what problem I would like you to look at for Monday, because we're okay. We could do a problem. Start working in your practice. And assignment listing. Let's see here. Probably P7-1, but let me make sure of that. Maybe even, you know, it's probably going to be 2, P7-1 and P7-8, but let me just double check. Sorry if I'm keeping you. I got another minute. Okay, so P7-1, okay, uncollectibles, yeah, that's good. And then P7, maybe not. Oh no, just P7-1. If you can do that one. And then, let me see one more, hold on. I might've lied. Let me make sure of this other thing. Oh, come on. Exercise 729. Let me just see what exercise 729 is related to, and then maybe we'll do that too. I think that's a, no, you know what, just P7-1. It's a bank reconciliation. So Monday we'll go over that. We're going to go through notes receivables. We're going to talk about selling accounts receivables, which is something brand new. And we're going to look at bank reconciliations a little bit. So we got a lot on our plate for Monday, and then we'll finish up our homework next Wednesday, and then we'll be ready for our test. Anybody have anything for me? Any questions? All right then, thanks. Thanks for meeting with us virtually. Sorry about that. I will see you all on Monday, if not sooner. Have a good one.